Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Welcome to the BOGART Effect. This is James Bogart. I've got Aleks Spencer with me today, BOGART Wealth's astute and illustrious Chief Investment Officer. Thanks, Aleks, for joining. Today, we're going to talk about exchange-traded funds. So I'm going to let Aleks do all the talking because he's way smarter than I am. This is a fun conversation because I think there's a lot of misconceptions around what ETFs are, and the goal here is to educate the audience.
No, I mean, ETFs, for me, ETFs are exciting. It's the natural evolution of what's happening in the finance space. And the primary benefits with them, it's transparency and simplicity. That's what I love about them personally. To understand ETFs, I think we got to start at the history beginning with mutual funds. So first of all, mutual funds, basket of securities, stocks, bonds, derivatives, whatever you want to put in there, regulated under the Investment Company Act of 1940, what we call the 40 Act for short in the industry. And the 40 Act, what it did is it's a cornerstone for fund and investment regulations. And the purpose of it was to protect investors, provide more detailed disclosures. You can think of prospectus, investment objectives, fees, risks that are associated. You can also talk about some of the regulation of risk behaviors, leverage restrictions, those types of things.
But maybe quick step back though, right? Like
Sure.
A mutual fund was originally designed to be a bucket of securities, right? Like allows, a strategy to get pooled together. Mm-hmm. So whatever the strategy is, there's lots and lots and lots of different ones, just like there's lots and lots of different ETF strategies. But mutual funds were originally created to give an investor a pooled bucket for investment purposes. So like this was the beginning of S&P 500 bucket, right? Like, and then, you could have a dividend paying stock bucket or a growth stock bucket or a long short strategy or a gold fund. I mean, mutual funds were really the inception point for this concept around bundling of investments into one security.
That's 100% correct. It made it just easier to own a whole basket of securities. And the big thing with a mutual fund is a NAV that's priced once per day, net asset value. So you take all this basket of securities, you do a calculation on it, and you put what it's worth, and that's that one price that's published once per day at the end of the market, and usually gets published around 5, 6 o'clock at night, whatever it is.
7 to 7:30 if you want to get exact.
Yeah. So later on, well, it depends on the fund companies, but yes, you're correct.
It's actually really annoying because throughout the day, everything's going up and going down. With mutual funds, it's like after you have dinner.
Exactly. And I think annoying is a great word for it in that regards. And ETFs kind of built on that annoyance. I'm just going to use that now. With ETFs, you get the same basket of securities, stocks, bonds, whatever it's in it. It's way more transparent and straightforward. Whatever's in it has to be published daily, and you can see the holdings within. It's just one share class. Mutual fund, you have investment shares, institutional shares, you have load fees, some don't have different marketing fees, whatever it may be. ETFs, just the expense ratio. That's it. So again, way less annoying in that regards. And then the big advantage of ETFs over mutual funds is that real-time pricing throughout the day. You can see throughout the day. So you still have that NAV concept that gets published at the other end of the day. Again, net asset value. Plus you have what is called intraday indicative value, IIV, which is what you see published on an exchange. Just like in a stock, you can see the price of where it's trading. The next big advantage is tax efficiency. That's the big one for ETFs, the big winner here. And there's multiple layers to this. The first one is pretty straightforward. In an ETF, you own one share of the fund or whatever it is you're buying. That's your share of it. In a mutual fund, you have proportional share of the entire pool. If a big investor leaves and sells all their shares, whoever's left gets stuck holding the bag with all the taxes and all the implications of what's there. In an ETF, it's you own your own little slice, if you will. The other aspect of what makes an ETF so tax efficient is something called an in-kind creation. Now, this gets a little technical, gets a little complicated. To try to break it down, the way you can think of it is as retailers or institutional shareholders, you buy ETFs, in your brokerage account, for example, right? That gets wired to an exchange where there's an intermediary in there called a market maker. They kind of aggregate those shares and, take your cash, whatever. And if they need to get more shares to give to the public, they'll go to the fund company, a Vanguard, Invesco, whatever it may be, and get more shares. Now, they can give those shares to those fund companies as either cash to get more shares, or they can give a basket of securities directly, which resets the basis of what's being held within there and vice versa. And ultimately, if you hear nothing else from this, what it means is at the end of the year, mutual funds, you get those big long-term capital gains distributions. ETFs, you don't see that as much.
Well, and I think part of it is the ETFs are doing it more real time, right? Like as it's happening, those distributions are happening throughout the year. It's a lot more transparent and easy to see what's going to happen. With the mutual funds, the bigger frustration is they usually all happen right at the end of the year, and for some investors, it can be a huge surprise on that tax implication, especially if you own these types of investments in non-qualified accounts, so a brokerage account, trust account, individual, joint account, et cetera. If it's in a retirement account, I don't want to say we don't care, but for tax purposes, we don't care because the capital gain distribution in an IRA account is not getting passed on to the investor like it is in a brokerage account, right? So this tax efficiency conversation, truthfully, it's meaningful. It's very, very real, especially when we're trying to integrate tax optimization work at a more, let's just say, meaningful way. And so, when we're looking at things, for example, like Roth conversion strategies or charitable giving strategies, all the things that we're doing right now at the end of the year, and let's say we've been doing all this detailed pro forma analysis and we're ready to go or we've already executed, and then boom, December 15th comes, I'm making up the date, but December 15th comes and we get a massive capital gain distribution from one of these mutual funds. And it wasn't anticipated, it wasn't projected. By the way, the mutual fund companies usually only tell us, what, Aleks, first week of December, second week of December, what we can start to anticipate. But even then, we won't really know until the actual distribution happens. And by the way, if you own a mutual fund that pays these capital gains distributions and you have it set to reinvest that back in, what ends up happening is you get this taxable event that occurs. And let's just say it distributes 3% of the position. So on one day, the mutual fund position will go down by 3%. Yep. The next day, your capital gains distribution will post into your account. So the position goes back up by 3%. So on paper, it looks like you have the same amount or close to, right? Obviously, you're going to have market fluctuations, but you still have the tax event that you have to pay the tax on. And so it comes back to this whole conversation around tax efficiency, transparency, predictability, and I'd say just an enhancement to the overall investment experience associated with being in an ETF versus being in a mutual fund. By the way, the intention of this podcast is not to bash mutual funds.
I was just going to say,
I feel like we're just like going down a road of bashing mutual funds, and that's not the case. There are lots and lots of great reasons why you would be in mutual funds, and we still have mutual funds in our portfolio allocations. And I think ultimately the reason why we have mutual funds versus ETFs is there are still certain asset classes or fund managers that have had a history of showing consistent, predictable returns that justifies the expense associated with being in the mutual fund. I mean, I look at T. Rowe Price, Capital Appreciation. I mean, goodness, we've owned that fund, I mean, the entire time Bogart Wealth, but even far even before that, when we were at RBC and Morgan Stanley. I mean, that's been a long-standing position. I think it's our largest position, Aleks. Is that correct?
Yep. And really quickly, I'm glad you said that, because it was kind of, here we are saying all the wonderful things of ETFs and not enough credit on mutual funds. But no, the reason I brought up the 40 Act is because that transparency, I do think ETFs built on that to make it easier, to make it just simpler and straightforward. But why are mutual funds also still good? In the sense that for a fund manager, when you don't have to disclose some of these things, it does make it easier to, your secret sauce, some of these things, some of these strategies are in there, some brilliant ideas in there that perhaps you don't want to disclose all of that information right away to protect some of the investors within. And also some of the liquidity things, ETFs, it can get a little trickier in that sense, the underlying holdings. So mutual funds have more ability to go into some of these obscure spaces. Now, ETFs, let's talk about, the proliferation is the other thing that's happened with ETFs, that I think this is where, unfortunately, it has lost a little bit of some of that simplicity of ETFs. It's, I call it like evolution of milk at the grocery store. Remember, it used to be just one type of milk that would be there. And now you have, 100 different types?
Yeah, and it used to just be passive, like it's an index.
That's it.
And now the world of ETFs is, I would say the world is your oyster. There's just so many different options, from owning the S&P 500 or the NASDAQ to owning Bitcoin via an ETF, right? There's just so many different flavors of ETFs now.
There really are. It's like the passive, the active, the semi-active, and I think that's all created some misconceptions around ETFs. ETFs are always index-based. ETFs are always low cost. ETFs are always diversified, whatever it may be. So perhaps maybe let's touch on that real quickly. For passively managed ETFs, so what are those? We call that beta exposure. This is your plain vanilla, like you said. You just own the S&P, you just own the NASDAQ, you own a sector. Usually low cost is what you're going for, just direct exposure.
Which by the way, like if we're comparing those passive ones versus the mutual fund, historically speaking, they are less expensive, right? Like if I just think of Vanguard, which Vanguard is known as being the cheapest possible option. But like being in a VOO, which is the Vanguard S&P 500 versus the Vanguard's S&P 500 mutual fund, like it's actually cheaper to be in the ETF, right?
It's operationally more expensive to run a mutual fund. So yes.
Well, and I think it's also important to note some mutual funds carry transaction fees with them that ETFs do not. So there's not only the cost of the fund itself, which is embedded in the performance number, but there's, in some instances, a transaction fee associated with getting in or getting out of said mutual fund. So it's just something to make sure you're being educated upon.
I agree. And then, building on all of this, so we talked about passively managed ETFs. There's also actively managed ETFs. That's becoming a bigger thing now. In actively managed ETF, we're trying to target alpha or excess returns, or perhaps it's some sort of risk mitigation. So managers are doing that just because it's accessible. They know that the market just likes the tax efficiency. So more managers are doing that, and they can be higher costing, and not necessarily the single digit, basis point cost that you see. This can get more into the 30 basis points, 50 basis points, even closer to 100 basis points, 1% expense ratios. That is something you can see with the actively managed ETFs.
But I guess real quick, Aleks, why would we go into active versus passive? Like this is almost more of a philosophical conversation around investments, but we've got a little time here. Why would an investor want to be in an active position versus a passive position?
So for me, there was this period that we went through that it was all about chasing low cost and let's just go to the cheapest version and get an index. And that's all well and great. But I do think that active managers, there's plenty of them that are fantastic at what they do in achieving returns, excess returns. above the benchmarks or whatever they're doing. So in this case, I like to look at it as, is it low cost is the objective, or is some sort of excess return risk mitigation the objective? And the two are kind of, think of it as a seesaw. I mean, you can go either way, how you want to balance it out, depending on how you want to round out the portfolio.
Well, and I think about like the periodic table of investing, right? Like you want to be in different asset classes, but simultaneously you also want to be in different strategies associated with it. And this is where I know I'm kind of leading the witness here because we have active and passive positions in the portfolios, but there's a reason for it, specifically because we want to make sure that we're divesting of asset class, but we're also wanting to make sure that we're divesting of strategy as well.
Agreed. And you also now have these kind of like semi-active, trying to blend the two things. So what is that? Or multi-factor, you'll hear it. So now we're balancing, again, the alpha and the beta, the broad exposure versus the excess returns. And the way folks are doing that is you take an index like this, S&P 500, for example, and let's put an algorithm that just automatically screens out for anything that's high volatility or screens out for anything that doesn't have growth over X percent or that has debt to equity ratio at whatever. So whatever factor you want to isolate, that's what the semi-active approach is doing. And that will balance the cost because now you don't have more of that human capital making decisions. It's just an automatic algorithm going through it. And that can also have its time periods where it works, where it doesn't. So there is that factor to it.
Yep. And one of the things that I would tell you, I think ETFs sit nicely when we're not only trying to diversify risk and bring costs down, but I also think that it's nice, especially for an investor that already has a concentrated position. We can use the ETFs as a mechanism to help with a diversification tool. And it sits nicely, especially when we have patient capital that we know we're not ready to sell out of a position or not, but we really do need to have diversification at a broader spectrum, right?
I think that's a good point. Like when to choose which ETF. I mean, some things that I would throw out there about how to pick the right ETF for you, use cases and awareness. One thing I think about is margin of error, perhaps. If you're the type that wants to do a single stock, you like an AI stock, and if you can do all the research on it, you want to do all of that, fantastic, go for it. But perhaps you don't want to do that. You don't have the capacity for it. You just want an AI exposure. So you can just get in an ETF, get a basket of AI stocks in there. And that way you don't deal with one bad earnings report or whatever it may be. So that's one approach. Another thing you can do is unique niche exposures. Again, I mentioned AI or nuclear space, different ways we can do it, or power grid. Yep. Then the other thing is simple portfolio construction too. What if you want to own the S&P or ACWI and pair that up with the AGS, AGG ETF, something like that, and you can make your own 60-40 in that mix or 80-20, and of course, add whatever other regions and sectors and styles. That's a nice way to get a broad exposure.
Well, and I think just pulling on that a little bit more, right? Like every investor has a different risk profile. And I think the nice part about ETFs is it allows you to get diversified exposure without having to overly complicate your investment thesis or narrative. Like, sure, everybody wished they had 100% of their portfolio in NVIDIA stock, right? Like, I mean, the reality of it is in 2022, you would probably have a very different impression, right? But fast forward to where we are now, investing is always easier in the rearview mirror. I think it's extremely important to remember what is your timeline, what is your comfort level with risk, and then ultimately set up the investment thesis to be aligned with both of those. And I think investors, they get so, and I know this is a terribly generalized statement, but they get so consumed with like performance relative to X. Well, did you take on that level of risk? I mean, maybe not. And yeah, I would agree. If you took on more risk than the appropriate benchmark, but you didn't get commensurate level of return with it, then I think you should be scrutinizing that investment thesis. That said, I also think it's important to remember every part of a portfolio has periods of time where it performs and outperforms, and periods of time when it underperforms. Like 2025 was the year where we finally got credit for having international exposure and emerging market exposure, because the decade leading up to it was on a relative basis underperformance. Now, that said, 2025, it dramatically outperformed. And I actually think going into 26 and even potentially beyond, there's a lot of opportunities in international asset classes and emerging market asset classes that should not be ignored. And that's why when I think about an investor that's in the accumulation phase of their lives, the simplicity of an ETF is great. But I think it's important to go beyond just one respective benchmark, right? Like, it shouldn't be just as US equities. It should include some international and some small caps and some mid caps, right? And it should, and depending upon your risk profile, if you're going to need the funds in a shorter magnitude of time, you should have different types of fixed income investments in that asset class, and then in that overall investment strategy and focus. I think it's important to maintain diversification. And frankly, coming back to this whole conversation, ETFs are a great way of doing it because it's low cost, it's passive in nature, or active or semi-active. It allows you to get diversified exposure without having to overly complicate the narrative.
I would say one last thing the awareness piece of ETFs, be mindful of the exposure that you're getting within it, how they're doing it. Some ETFs have leverage or inverse, so be careful with that, or unless maybe you want that. The other thing, it's direct versus indirect exposure in that regards. So let's use Bitcoin and gold, which are all popular right now. Are you actually owning gold bullion and underlying cryptocurrency, or are you owning some derivative or some other futures product that's giving you the price performance of that, trying to mimic the underlying assets? So the performance may not be direct. And then the last piece, I would say, it's liquidity is the beauty of ETFs. Some of these major ETFs that trade out there, they're bid-ask, what you can buy and sell at. Usually trade about a penny wide is what we target, maybe a couple pennies, something like that. When you get into these ETFs that are newer and perhaps not as liquid, and they get to 5 or 10 cents wide or something like that, got to ask the question, is it because they're in some space of the market that, like an emerging market bond and some frontier market, and that's why it's that wide? Or is it just it's not that popular, it doesn't trade that often in the underlying? Be careful with that, because that can erode performance without even being aware of it.
So I just want to pull on both of those to make sure our audience fully understands that. So the first one you talked about was the composition of the ETF. Understand how that ETF is being built. And what happens sometimes is, we talk about ETFs as these bundles where, and let's use the S&P 500 because that's really easy to explain. You buy an S&P 500 ETF, you would assume that you own a piece of those 500 companies. But that is not always the case. Some of these ETFs are built where instead of buying the 500 companies, they're buying derivatives or specifically options on those 500 companies, and they can mimic the overall exposure of the S&P 500, but you yourself don't actually own a piece of those 500 companies. I would encourage, if that is what your agenda is, where you want to own the actual 500 companies, not a derivative component of it, make sure you're sticking with some of the bigger, more broader based ETFs, like a Vanguard, right? Like, or even, Fidelity Schwab, like the custodians have good ETFs that are well traded and are owning the actual underlying asset class that they're investing in. And similar to your point, be aware of how actively traded the ETF position itself is, because some of these smaller companies, if you're not seeing a lot of volume, you can get a large price disparity, right? So, you might see where you're ready to sell a position, but because there's not a buyer, this is why when we talk about bid and ask, you need a buyer for every seller. If there's not a buyer, there could be a discrepancy between what you're willing to sell it for and what someone's willing to buy it for. Usually it's this way. But the point is that you can be at an odd. And that's why we like bigger ETFs that tend to have bigger volume. And candidly, we're very blessed that Bogart Wealth continues to grow in size. But when we do an ETF trade, it's usually tens of millions of dollars, sometimes hundreds of millions of dollars, depending on the trade, that we can move a position that doesn't have a lot of volume. And so, it's just important to note you understand what you're investing in when you're investing in it. I would say that that's a general theme of any investing strategies is get educated. And that's partly why, we do talks like this. But we're more than happy to be a resource. And frankly, this is an area where I think there's a lot of as we've already identified in the podcast here, there's a lot of misconceptions. And we want to make sure that we are absolutely aligned and making sure that you as an investor are educated in what we're doing or even what you're doing outside of what we're helping with. But thanks for joining us for the podcast today. Aleks, thanks for the time. This was great.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.